let's get our first guest on board. Gary Schlossberg, global strategist at Wells Fargo Investment, joins us now to talk more about, the two big cues that we have on our hand. Gary, it's a pleasure speaking with you on the channel. There are two sort of triggers at the opposite ends of the spectrum, right? On one hand, India could be added in the JP Morgan Global Bond Index, which could mean big inflows coming into our markets. But on the other hand, there is this overhang of negative global cues. Which way is the wind blowing, according to you?
Well, globally, of course, the Federal Reserve set the tone. There were a number of central bank meetings yesterday that put interest rates on hold with a few exceptions, but the tone was really set by the Federal Reserve. I think what they did is really tilt expectations. Those expectations were a bit optimistic, looking for aggressive interest rate cuts by the Federal Reserve in 2024. And the Fed wanted to bring them back toward the middle of the lane by raising some doubts about just when the Fed would be cutting interest rates and how aggressively. We still look for the Federal Reserve to raise rates perhaps one more time before the year's out. Could come later rather than sooner, but the bias is toward higher rates, and the market is reacting to that more sober expectation on the rate outlook.
All right. Hi, Gary. Gary, the other point that we have been dealing with for the last few days in terms of global cues is a potential U.S. government shutdown. Now, if that happens, then maybe data may not be available, and also growth out there could slow down. Given that sort of a scenario, do you expect this last rate hike to be postponed? Maybe we don't see one in November?
Well, that's why I said later rather than sooner, a bit later in the year. We had been looking for a November 1 rate increase. I still think it's possible, but given the paucity of data, when the government does shut down, the Fed, in all likelihood, at the margin, will be a good deal more cautious. And that could have the effect of putting that rate increase, pushing it back to the final meeting of the year in December. Keep in mind, so much of what the Fed does between now and year end depends on the economic data, particularly the price indexes, that it'll be very reluctant to move unless it has a clear view of both growth and inflation.
Gary, wanted to get your thoughts in on the Indian bond markets. Now, JP Morgan has said that India will now be included in its widely tracked emerging market debt index with a weightage of up to 10%. The inflows will be staggered starting from June of 2024, but we're talking about big money. UBS estimates $20 billion of one-time inflows. Again, staggered, but it's, we've opened the floodgates for large money into the Indian bond markets. How do you read this development and the implications?
Clearly positive for India. As you pointed out earlier, it adds to the liquidity in the market, hopefully reducing at the margin volatility. In and of itself, the influx of money is a positive for the bond market. But as you pointed out earlier, all this against the backdrop of what's going on globally. And at least for now, the global outlook, I think, is more guarded on interest rates, more guarded on the economy. By next year, we could see global interest rates trending lower in reaction to what we think will be a global economic slowdown by early next year. And that just creates an added tailwind for the Indian bond market. But in and of itself, clearly a positive over the long term, as your colleague correctly pointed out earlier.
Just leave us with one view on how Indian equity investors should approach the markets now. I mean, it's been a handsome rally, right? 9% on the index, almost 30% on the mid-cap index. Do you take your profits and move out, or do you continue to stay invested in a market like India?
Clearly, in the case of India, a difficult choice. You're dealing with higher global interest rates, the threat of a global growth slowdown, if not an outright economic slowdown. You're dealing with higher oil prices, which hit India particularly hard compared to most other economies in the world, certainly among the more dependent oil importers. Weighed against that, though, at the moment, one of the most rapidly growing areas in Asia, if not the world, of well-balanced economic growth. The long-term outlook certainly positive. The nearshoring theme certainly weighing in India's favor. I would say near term, you become more cautious. But if you're a longer term investor, you look through over the next 6 to 8 months what's happening globally. India has to be attractive. I'd be very careful about reducing exposure there, certainly to other emerging markets.
All right, we leave it at that. That's a great way to end the discussion, right? India has to be in your portfolio. It continues to be a very attractive market. I'm sure our viewers would like to hear that. Thanks a lot, Gary. Have a great weekend and look forward to speaking to you again soon.